Good day, and welcome to the Q2FY23 earnings conference call of Tech Mahindra Limited. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. C.P. Gurnani, MD and CEO for Tech Mahindra. Thank you, and over to you, sir.
Yeah, thank you. Good evening to all. Welcome to our earnings call for Q2 FY 2023. I know the last few years have been a little challenging. On one end, we had the pandemic. The other end, we had disruptive technologies, climate change. So all I can say is that we remain focused on our core purpose. We have aligned ourselves to the new world norms, and we continue to drive positive change in the lives of our communities. We will continue to rise on the three pillars of more equal world, being future ready, and creating value. Our efforts in sustainability, our efforts in diversity, our efforts in equality have yielded very, very good results. We have been creating value for the stakeholders and the community alike. We have delivered reasonably good financial outcomes, and we do believe we are making a lasting impact. We constantly believe and practice there is no trade-off between purpose and profit. So thank you again for your support. Our strategy on focusing on data, focusing on discipline, focusing on new competencies, new technology development has resulted in profitable growth, 3% quarter-on-quarter in CC terms, revenue now close to 1640 million. TME has grown 3.1% in CC terms. Enterprise has grown 2.8% in CC terms. On a year-on-year basis, CMC has grown little over 20% on CC terms, and enterprise verticals have grown 14.4% on CC. Our team, Agarwal's focus on integrating the acquisitions, driving synergy goals continue to give us good returns and good results. Large deals, we had committed that we would be in the range of 700 to a billion. We think that 716, despite of some of the last minute slowdown in decision making, is a good result. EBITDA margin also, we gave the salary hike, but we still delivered 15.1%. That's basically because of a very sharp focus on operating metrics. Generated a free cash flow of 253 million, which is again one of the better ones. The board has agreed to a special dividend of 18 rupees per share, but most of this I would like to say Rohit can cover in detail. On a management perspective, me and the management team are cautious of the slowdown and the coming winter. We have made our own plans A, B, and C. We will be agile, we will adopt, and we will continue to monitor the global situations. So I genuinely believe that the company is in a better shape as we go through some of the rough economic conditions, but more important is that your technology investments in Metaverse, and I'm sure Manish will share in detail, 5G connectivity, customer experience management, some of the investments that we have done on the network operations are all yielding good results. So between Rohit and Manish, they will share more about numbers and the competencies that we have developed. Over to you, Rohit.
Thanks, CP. Good evening, everyone. Let me now cover the company financials for Q2 ended September 2022. We ended our second quarter with revenues of $1,638 million versus $1,632 million last quarter, up 2.9% QOQ in a constant currency basis. Growth was broad-based, with CME growing at 3.1%, enterprise growing at 2.8%, both in constant currency terms. Our deal win continues to look positive with the TCV closure value of $716 million. Revenue in INR terms was at 13,129 crore versus 12,708 crore in Q1, up 3.3% quarter-over-quarter. The EBIT for the quarter was at $184 million in rupee terms 1,492 crores versus 177 million in Q1. The EBIT margin was 11.4%, an improvement of 40 basis point QOQ on a reported basis, and an improvement of 70 basis point on a constant currency basis. As we've articulated earlier, we've executed on improving utilization, which has eased the margin by 60 basis point. We've also taken measures on discontinuing certain low margin business, which had helped the margin by 20 basis point. We've got sales G&A savings of 60 basis point. Price improvements, which we'd articulated before, we're working on with customers, has helped us in the quarter by 50 basis point consecutively now for 2 quarters in a row. And this all, as CP mentioned, was impact helped us offset the wage hike and inflation, which was around 120 basis point. And then the currency, which I mentioned for us, was a tail headwind of 30 basis point. That's the broad margin drivers. Moving on from EBIT to other income for the quarter, it was at 36 million versus 16 million in Q1. Foreign gains were higher compared to the previous quarter, from 16 million versus 7. The tax rate for the quarter settled at 21.9%, which is lower from last quarter of 22.8. This is because certain one-off items we saw in Q2. Normalized tax rate for us is around 25 to 26%, which we'd articulated earlier. The net profit margin for the quarter is at 9.8%, which is a 90 basis point improvement from Q1 and close to 120 basis point improvement on a constant currency basis. Our free cash flow for Q2 FY23 was at 253 million, which is 159% of PAT, as we catch up over the spillover effect that we saw from Q1. Our DSO has increased by 2 days, from 100 to 98, and driven by better collection rigor and operating follow-ups. As I mentioned earlier, we continue to consistently follow a rule-based hedging policy. As of September 2022, the total hedge book was at 2.4 billion versus 2.3 in Q1 23. Based on hedge accounting treatment, net mark-to-market gain for 30th September was at 75 million, out of which 16 million went to the P&L, and the gain of 59 million went to the reserves. We had cash and cash equivalents of 947 million, in rupee terms 7,703 crores. We are committed to prudent capital allocation and returning back to the shareholders. On that basis, the Tech Mahindra board has approved a special dividend of 18 rupees per share, which compared to last midpoint is a 20% increase from last year. With that, I open it up to Q&A for the rest of the time we have for the call.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Chirag Kacharia from Ashika Institutional Equities. Please go ahead.
Questions. In net new deal wins during the quarter, if you can provide the bifurcation for enterprise and communication vertical. Second question, geography-wise, which territory you feel that highly impacted due to the slowdown? And also vertical-wise, other than communication segment vertical specific, any observation you witnessed that the client delaying their decision making in terms of tech spend? Which are those areas? That's it from my side.
Sure. So from a deal win perspective, we've stopped that disclosure of split between communication and enterprise. But I can let you know that communications, and Manish will talk more, continues to benefit from the 5G tailwind that we have, and in the marketplace, our position in that area benefits us from a consulting to an execution standpoint. So that continues to be a tailwind. From a revenue growth perspective, geography growth is quite broad-based this time. US has grown 2.5%. Europe, when adjusted for currency, has grown 3.5%, and the rest of the world, adjusted for currency, has grown 3.4%. So it's been broad-based from a geo perspective as well. When you look at decision making, I would say nothing that is a trend that we see right now from a customer behavior standpoint that is coming out. But given the macroeconomic environment, the impact of the war on Europe intensifying the energy pricing and overall inflation in Europe, I think that's something that is, from a geopolitical standpoint, going to have a bigger impact, we feel. But nothing that yet percolated down into our customer behavior. So that's the current view we have. So as we go forward, pipeline still looks robust. Our deal momentum continues, but we'll continue to watch the environment cautiously.
Many Indian telecom operators started giving orders for their 5G related requirement. So how we place to take benefit of those because our major concentration is outside India, and also a lot of PLI scheme introduced by government but to make India telecom equipment manufacturing hub. So how our design vertical is placed to take advantage of it?
Yeah. Manish, would you like to take that question, please?
Yeah, absolutely. No, I think, Kiran, thank you for asking that question. As far as the telecom network equipment business is concerned, I think we have always said that that's not a business that we are participating in. We want to continue to stay focused. Even CP alluded to earlier. We appreciate all your guidance as well in keeping us focused on our core and core purpose. So software integration, engineering, both around software equipment as well as devices and operations, I think are the focus areas that we continue to be a dominant player across the world, including in India. As the design happens and as the rollouts will happen, we will continue to work with the service providers in India in helping them realize the value of the network. As far as the underlying, the physicality of building the network and deploying it, that's it's probably the very voluminous game, but it is not something that aligns with our business strategy, balancing our long-term strategy with profitability and of course our core competence. So I think we are very clear what we will do, and we are positioned very, very well. In fact, we've also one of the businesses that we have won is around supporting one of the Indian service providers in helping with their enterprise 5G business. So we continue to play that role, and we feel very good about it with all the major operators in India.
Thank you. All the best, sir.
Thank you. The next question is from the line of Ravi Menon from Macquarie. Please go ahead.
Hi, thank you for the opportunity. High-tech is a vertical that most of the peers have not really reported.
If you can speak closer to the device, please. Your audio is not clearly audible.
High tech is a vertical that most of the peers have not reported good growth in, but your growth here is very strong on a sequential basis. Are there any new accounts that we've entered through acquisitions like Analysts and InfoStar that are helping us here?
Yeah, so, as we mentioned, I think almost 3 quarters back, this is an area or vertical for us, which is a growth driver. We have invested both inorganically and organically in the competencies that are helping us drive growth here. So from either the capabilities that we built in from either cloud competency perspective or areas that you mentioned are helping us drive growth from better customer coverage, making sure we are getting better share of the wallet with each customer because we have multiple competencies to offer. And then, the combination of service offering that we acquired, combining with our core IT competencies together are giving us better deal wins and better penetration of those customers. So it's all, jointly working together in that vertical, which is helping us. So we see the momentum continue as we move forward with more and more penetration on existing customers. So less of, I would say, new customers added, but more customer penetration that continues to be strong. Jagdish, you want to add something? You're on the call as well.
Yes. Yeah. Thanks, Rohit. So I think one of the things that's actually helping us, as Rohit said, is both the organic and inorganic, but mainly our strategy with hyperscalers. That we see as the one key driver that's helping us drive growth in a complete 360-degree manner, working with them in creating market opportunities and working to them about creating some of their product development, digital engineering parts, and so on and so forth. That's driving primarily the growth, and we see this as a continued momentum that we want to continue.
Great, thanks. Given that we got good deal wins this quarter as well, and utilization is already pretty high at 85%, why have you chosen to allow our software headcount to decline quarter on quarter?
So this was something we'd articulated even last quarter, that we've made certain investments in the business over the last previous 2 quarters, and we want to use this quarter to improve our operational efficiency and performance. And the utilization, which we peaked at a period of 89%, I think we still are 85, right? So we've, come based on those investments, we've come back from as low as 80 to 83% now to 85. And we still have, room to go forward. So this we'd articulated, earlier as well. So as we move forward based on the demand environment, the pipeline that I said is looking positive, we'll continue to drive additions on those skills as well as continue to utilize the internal talent base, which we're skilling in different digital skills better as we move forward.
Right. Could we assume that some of this, though it is showing up as utilized, is not really translating to billing, and should we expect some realization improvements to help us?
Yeah, it would. I mean, from this quarter aspect as well, it does help us from a revenue growth perspective with increased utilization, margin gets better, and as we move forward, we'll continue to see that happen. So, yeah, I mean, we still have operational room for us to drive both revenue growth as well as margin expansion.
Right. Thank you.
Thank you. The next question is from the line of Rishi Jhunjhunwala from IIFL Institutional Equities. Please go ahead.
Yeah, thanks for the opportunity. 2 questions here. Firstly, there seems to be a very sharp decline on a sequential basis on our top 5 clients, and even adjusting for cross currency, it seems that there would have been a decline in a quarter which is otherwise seasonally strong. So just wanted to understand any peculiar cases of ramp downs that we have witnessed or any pricing corrections there?
Not really. I mean, pricing is on an upward trend, as I mentioned, so not really pricing. But there was a couple of projects which, from an implementation closure perspective, came to a close from a timeline perspective. So that caused a dip, but otherwise no trend in any of those customers beyond that.
Understood. Second is on the margin side. So, given that wage hikes are behind us and 3Q, 4Q, we see some momentum in some of the verticals there. But on the flip side, we have cut down slightly on the hiring. So just wanted to understand, the trajectory from a margin perspective. Are we still on track to exit at 14% for the year?
I think as I mentioned earlier, right, our levers continue to be similar. We still have headroom to go in each of those. So as we said, I'll repeat all those actions. So pricing continues to be a very strong lever for us. We work it as a program. We're continuously going for opportunities there, so that will continue to drive margins for us in the current quarter as well. We look at utilization, as I mentioned. We still have path to get better there as we move forward. We are also looking at a lot of internal efficiencies by combining certain support and middle office functions. That gives us some benefit as well on operating performance and leverage. So we'll be driving that as well. Offshoring, while we did a lot of actions there, but some of the new deals had some on-site component which doesn't show in terms of improvement, but we'll continue to drive that going forward as well. And if you see subcon, we are still at a high level, though we've reduced it quarter of quarter. But those are the programs that we feel that we have enough juice left from a margin expansion standpoint. So that all will continue, and we'll drive it like a program. Also, we're continuously looking at areas with low margin profile and take a call on either divesting or discontinuing that. In this quarter, I mentioned that we took action on a portion of that business which reflects in the BFSI segment, and that gave us a margin uplift, but mellowed down the growth, which otherwise at a company level would have been close to 3.4%. So we'll drive all those actions. I think what we'll have to also continue to look at is the global economic scenario, how it reflects in the second half. I think that's something that we'll watch and be cautious about as we continue to drive these actions.
Understood. And just one thing on impairment charge that we've taken in this quarter. On the consol financial, the impact is 244 million, but on the standalone, the impact is more than 4 billion rupees. So, one, which subsidiaries or acquisitions are these related to? And secondly, why is there such a big gap between the two?
Yeah, at a consolidated level, I would say it was a small investment we'd made around 12 to 14 months back, which didn't get us the right value we anticipated. So we took a proactive call to move out of that. So that's the impact on the consolidated side, which is pretty small investment, and hence the impact being so low. At a standalone level, as we articulated before, it's not really the legal entity view that we should look at, because when we're working, across the company, it's more across legal entities that the projects are delivered, and hence it's a little bit more from management view. So hence, from a legal entity perspective, that doesn't really reflect the performance of that segment. But from a main impact perspective, it's Target, which is the entity where we've taken the impact.
Understood. Thank you so much.
Thank you. The next question is from the line of Ruchi Burde Mukija from Elara Capital. Please go ahead.
Thank you for the opportunity. Two of my questions are answered. I have two more. So you've been talking about portfolio pruning as a lever for margin. Could you talk us about how this process is now progressing, and when do you expect it to conclude? That's one. And secondly, if you could talk about some indications from client on furloughs, how do we see December quarter in terms of furloughs? That's about it.
Yeah, so I think from an estimate perspective, we said our actions are targeted around 120 million annualized revenue impact that we're kind of looking at, which we've identified low margin either from a divestment or discontinue business operation standpoint. We've executed on an annualized basis almost 60 million of that, which is reflecting in the current quarter, and we are close to executing the rest in the next 2 quarters as we move forward. So through an annualized basis should be anywhere between 100 and 120 million impact.
On furlough indications?
Yeah, so furlough, no different trend, from what we saw last time. I think we're still looking and evaluating as we move forward with our customer base. So maybe marginally higher than what we've seen in the past. Also we have actions to mitigate some of it. So we're working through that in the current quarter as we move forward. But I won't say substantial difference from what we've seen in the past. Maybe a little bit on the higher side is what we're seeing.
Thank you.
Thank you. The next question is from the line of Vibhor Singhal from PhillipCapital. Please go ahead.
Yeah, hi. Good evening. Thanks for taking my question. Just a couple of clarifications. I probably didn't get this properly. You mentioned that this portfolio pruning exercise might continue for next 2 quarters as well.
Yes, that's right. That's right.
And basically by the end of this calendar year, with this financial year, 4Q this year, we expect this process to end. And thereafter, the margin benefit that you say will probably start flowing down as well.
Yeah, I mean, from a action perspective for this year, that's what we'd identified and we'll execute. So from that perspective, that's the target we kept for ourselves. And, this is an exercise that we will keep on discussing as we move forward into next year. We still have some pruning to do, but for now, that's our immediate focus that we had to execute, and we'll keep you updated on the progress.
Okay, so as of now, we are looking at the activities that we have decided upon. That should end by 4Q, but we might take upon similar exercise next year also. That's what you're saying, right?
Yes, that's right.
Got it, sir. And just one last question. Our EBIT margin guidance remains, right? That we are looking to target 14% exit rate in 4Q this year.
Yes, I mean, Vibhor, from our perspective, as I mentioned, the headroom is still there on all the operating levers. We'll continue to drive that. As we move forward toward the second half, the growth environment and how the situation in Europe pans out will be an important driver, right? Because already when you look at it, while the reported EBIT is 11.4%, operational is more like 11.7%, right? So FX also plays a role there. So growth, FX, those will have some impact there, but we'll continue to work towards our actions that we've defined for ourselves. And given the Q2 execution, we continue to be confident that our actions are working, and we'll keep on working in that direction going forward as well.
Got it. And sir, since you touched upon the European part, if I could just squeeze in one more question, a more subjective kind. Basically, we are almost 1 month into the third quarter as well, and I'm sure there are some many parts of Europe that have already started seeing some sort of winter setting in. So what is the overall basically feedback that you're getting from clients, especially in Europe? I mean, how well are we prepared to face this winter? Are we concerned about plant shutdowns or similar kind of activity which might lead us to, not just us in terms of the entire industry per se, might lead to some loss of revenues or pushback or postponement of their IT capex? Any color on that would be really helpful.
Yeah, sure, Vibhor. I think for now, we're not seeing anything dramatic from a Europe standpoint yet. There are discussions that we're following it up more from a macro standpoint. We're looking at what the energy prices looks like. It's getting more and more steep, and the impact is obviously more in certain countries versus the other. But from a client standpoint, yet those specific discussions are not panning out. More not so much in Q3, but as we continue to move to Q4, we feel that is a potential that we need to watch out for.
Got it. Great, sir. Thank you so much for taking my questions, and wish you all the best.
Thank you, Vibhor.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Mukul Garg from Motilal Oswal Financial Services. Please go ahead.
Yeah, thank you.
Sorry, I just wanted to kind of follow up on, the plan to, kind of prune the 100 to 120 million annualized number. Is this mainly on account of, client-specific exits which you're planning, or is this also include, some actions we are taking it on investment or subsidiary fronts, where we might be exiting or we might be kind of trimming back, leading to an impact on revenues?
I mean, these are specific, different areas. So, non-strategic areas where we feel we're not getting the right, return on our investment, which doesn't have potential for us to scale up. So it's a mix of all of that, through which we've identified those actions, and what we've executed is one of that in those buckets. As we continue to move in the next 2 quarters on the similar lines, we'll drive that. So it's non-strategic, no scalable possibility of driving that improvement, and the return on investments really, really low right now.
Understood. And also, I think this is something which has been discussed, I think multiple times earlier also. But because you disclose your revenues on IT services and BPO separately, there seems to be a fairly wide gulf which sometimes appear between the two growth. Likewise this quarter. Any reason why the BPO grows, the BPS grows so strongly while IT services kind of trails it, or is this something which is I would say like a part of the same equation and it just gets reported that way? How should we see this going forward also, given the wide difference in the employee addition in both these spaces?
And so BPS does have seasonality impacts. So if you look at the current quarter, it's a headcount gets ramped up from a seasonality perspective. So that drives a little of those differences or dynamics, which creates the difference between both the areas. And from a overall perspective, BPS business, continues to drive better performance for us if you look at last, 6 to 8 quarters. So our investments that we did in that business, both organically and inorganically, are positioning us to drive, every quarter more than 5%, quarter-over-quarter growth. So that trend continues, and the current quarter difference is more driven by seasonality more than anything else.
Sure. Thanks. And one final question on again, sorry, following up on margins. Given that you are taking multiple actions to meaningfully improve your profitability over the next 2 quarters, any initial thoughts on how should we think about FY24 in terms of levers which you guys have to continue to drive margin improvement from here onwards? Because again, there is a quarterly cycle that you exit Q4 at 14% or roundabouts, and then you will have wage hikes which will come in, which will again pull back your profitability numbers in 24 to where I think your 23 numbers will end up at. So how should we think about the levers which you guys have to further scale up after taking maybe 150-200 basis points over the next 2 quarters?
Yeah, so I think we articulated our actions which are short term, which is what we said. I just articulated before that we're driving, and we'll continue to drive that over the next 2 quarters. Those short term actions will continue because that's a regular part of our quarterly operations. But from a structural and long term perspective, there are 2 or 3 things that we'd articulated that we will do, which will not just drive change next year, but all more in terms of next 2 to 3 years, right? So one is the geography mix. If you look at our mix, we were around 47-48% US geography, which are now close to 52%. Obviously, some of it is FX impact that you see in the Europe, but even if you take that out, the mix in US is going up and Europe is going up versus rest of world, right? So that's one area we articulated around 12 months back that we will push to make our investments in those geos better. And hence change our mix over the next 3 years, more in line with getting that better towards driving better margins outcomes. So that's one area structurally that will see the difference. Second, we'd also articulated that some of the investments we've made in large deals, in executing, in setting the structures, COEs of making large deal execution and winning that as a investment, that will start giving us some benefit or kind of leverage as we move forward. And some of the large deals getting into the mode of 12 to 18 month cycle and post that giving margin benefit next year should give us return there as well over a year-on-year basis, right? So that's the second area. And then, as I mentioned, streamlining the portfolio on streaming out the low investment buckets will always be a drive that should continue to drive margins for us. So I think structurally that will continue for us as we move forward. And also when we look at our competencies, some of the competencies like digital engineering, which give us a better return, we are, through various organic and inorganic investments, developing those investments, and that also should give us a better margin mix as we move forward. So those are some of the areas that we're investing to drive better outcomes more structurally as we move into FY24.
Understood. Thanks a lot for answering my question.
Thank you. The next question is from the line of Sandeep Agarwal from Edelweiss. Please go ahead.
Yeah, thanks for taking my question. I have sorry. So two things. One, on the demand side, while I know that our performance till now doesn't reflect any kind of weakness, nor our discussion with customers are showing any signs of that. But what is your sense? Will we get more clarity when they start the next year budgets, or you think there will be some other signs which you would be tracking to gauge the demand for the next year? So that is number one. Number two, while I agree that you have answered in different ways the margin question, but I would like to still probe a little bit more on that. To think that the internal metrics are enough for internal operating metrics are enough for getting margin benefit from here, expansion from here, or you think that there are external levers as well, like there is a scope for price improvement or something which can further aid our margins? Thank you.
So on a demand view of second half, maybe I'll open it up respectively for comms, for Manish to give a view to you, and Jagdish and Vivek in terms of what we're seeing. But generally, maybe as a starting point, we continue to look at our pipeline on a very regular basis, how that's moving across geography, how that's moving across vertical. Our timeline to close deals, is that changing quarter over quarter from what we had to now on a significant basis or marginally? So we continue to monitor these triggers, and that's why I said when we look at those internal data trends, we don't see some of that reflect in what the macro discussions are. But I think as we get into second half and next year, I think a possible kind of recessionary phase seems imminent, more likely in Europe region than in US, and maybe US would lag with that impact more towards sometime middle of next year. So I think that will have a consideration impact on us as we think about second half at some point as well as for next year. So we're keeping all that in mind, and our internal actions are driven towards that possible scenario as well. I think specifically on those segments, maybe I'll just open it up first to Manish to talk about comms and how he's seeing the customer discussions as well as the view around the demand environment for the second half of next year.
Thank you, Rohit, and thank you, Sandeep, for that question. On the demand side, you're absolutely right. I think we will indeed continue to get more and more clarity as the year winds down and people finalize their budgets and assess this calendar year, this fiscal as well. But that said, I think our overall funnel and pipeline of all kinds of discussions that we are having across the world continue to remain very robust. So depending on the budget year, there could be an impact as we go forward with some of the decisions. But there hence could be some reprioritization of where the money is spent contrary to probably where the money was spent in the last 2 years on the technology side. But it is very, very clear that with all the gains that the enterprises have and the telcos have achieved over the last 2 years, the focus on tech spend will continue to remain high. There will be no doubt a little bit of reprioritization. For example, in the last cycle, they spent a lot of time and in continuing to build platforms for customer experience management. Going forward, we start seeing a lot of activity in building more an open design, open architecture, creating and converting their network assets into more of a platform play. So some of these stories will play out as the year ends and the next year starts. At this point, I think we do have both kinds of discussions that are happening in terms of looking at the current spend at the same time, which is a cost play, a savings play, and at the same time, some discussions around increasing the velocity on a few reprioritized digital projects, whether it is in the network realm or in the underlying digital realm. Absolutely, I think the next 2-3 months are going to be crucial to continue to watch for this space. Jagdish?
Thanks, Sandeep, for our question. I think there's similar commentary here also on the enterprise side to what Mohit spoke about.
Mr. Mitra? So sorry
Yeah?
to interrupt. Your audio is a bit muffled, sir.
Okay. Is this better?
Yes, sir. Please proceed.
Okay. So, hey, thanks. Just similar commentary, I think, to what you heard from Rohit and Manish. Primarily, we may see an impact in Europe, more so not that the deal pipeline or the demand is not growing, but probably decision-making on closure on certain things may have an impact in Europe, and so we'll have to watch it closely. But good part is that the investments we did on tech and continue to do around the 4 areas that we feel are critical, cloud, engineering, connectivity, and experience, and also our ongoing business around sustainability tech. These are things that we don't think are going to be cut down, and there will be a requirement for these service offerings, irrespective of the speed of decision making. So that, plus our large deal pipeline continues to look robust. So those are positives, and we'll probably have to keep a watch on how the decision making time frames, as Rohit said, is a key parameter that we keep a watch on.
Thank you. The next question is from the line of Girish Pai from NBI. Please go ahead.
Yeah, thank you for the opportunity. I had a few questions on price realization. Rohit, you sounded a bit cautious on pricing in the second half of FY23. Today, you seem to be sounding a bit more positive. Has something changed? Secondly, are you having any price-related pushback from any section of your clients with the kind of macro that you're seeing right now, and probably a shift away towards cost optimization or savings-related kind of work that you will probably see in the future?
Yeah, so on pricing, it's natural from a view perspective that, as we continue to see, and we've been looking at this from a macro perspective for a while now, right? So from that aspect, while we were confident of our internal program approach standpoint, but that impact was always looming and hence that view. But I think as we move forward, at least from a current quarter perspective, we continue to see the pipeline, which we can execute on and see that benefit that we've got over the last 2 quarters continue. And as things move, change, or whatever happens, I think that scenario will now probably play out in Q4 rather than Q3. So I think from that perspective, it's slightly better than what I'd anticipated. And our programmatic approach and pricing will continue. I think from a customer standpoint, there are, as Manish mentioned, some discussions going on various priorities of the customer are happening, and we are a critical part of that solutioning, either be it on their journey towards a cost approach standpoint that they're looking at, either from IT or even from a BPO standpoint. But I wouldn't say that it's radical or it's quite a number of them happening. It's right now not a trend that we see while we continue to proactively work with customers on those.
The other question has to do with CP's comments where he said, we've got about 716 million TCV, and he kind of hinted that we could have got a lot more, but because of decision making being slower. So, was there any specific geography or any particular verticals that where this concentration of the decision making being delayed that you saw?
Not any specific geography or vertical. It's just a couple of deals that from a closure perspective spilled over to the current month. And I mean, order booking and these decisions, that's why we always talk about a range. These are not that specific that you kind of decide that this is the time it's going to happen and it pans out, right? There's no other variables. So from that perspective, we're in the range, and hence the view from his side was the pipeline strong, and we continue to see momentum that reflects in that conversion, and hence the trend for now will continue as we move forward. I'm continuously reiterating that this is a dynamic scenario, and we're monitoring it closely. So that's an area that as we move into the next couple of months, we'll keep on updating you as we see any changes happening.
Lastly, this 700 million to $1 billion of TCV, that guidance, that remains for the next couple of quarters, or will that change?
Yeah, right now I think there's no reason for us to change that, and it stays for what we articulated. So yes.
Okay, thank you very much.
Thank you. The next question is from the line of Venkat Samala from DSP Investment Managers. Please go ahead.
Hello, am I audible?
Yes, sir.
Yeah. Thanks a lot for the opportunity. I know enough questions have been asked on the margins, but then just a little further probing on that. You did mention a lot of levers plus the portfolio pruning exercise that we are undertaking, right? Given the fact that this quarter we had wage hike headwind for us, and given the lever that you spoke about, which will play out into in H2 as well, should we expect a more sharper ramp up in margins versus 30-40 bits that we saw this quarter?
Yeah, as I mentioned before, I think our actions still have headroom in that and continue to drive that. The precursor that I continue to reiterate is how the growth pans out, and compared to first half, there's a little bit more uncertainty. Furloughs is an example we spoke about, which is marginally higher, as I mentioned, and then other dynamics which might change as we enter the Q4. So growth obviously will have a little bit of impact on how those translate into the P&L. So from our perspective, I think all we are focusing on is driving those actions and ensuring that what we set ourselves as goals, we continue to drive that as we move forward.
Understood. And a related question to that is, the proactive portfolio pruning that we are doing, do you think it will present a material revenue headwind on a net basis for us in H2, given the fact that, we are...
Seems like we lost the connection for Mr. Samala. We move to the next question from the line of Viraj Kacharia from SIMPL. Please go ahead.
Yeah, hi. Thanks for the opportunity. I just have two questions. First, I didn't get the explanation on the impairment charge in the standalone operation. So if you can explain again, please, what is the charge relating to?
Yeah, so on a impairment basis, as we mentioned before, our strategy is to integrate businesses as we, kind of do our, we'd articulated a few sessions back, I don't remember, maybe 6 to 9 months back, we did a specific M&A session with Vivek, and we articulated that our strategy is now to integrate all the portfolio companies in the core business, and that integration means front office, back office, and also the business that we do doesn't follow a specific legal entity model, right? So to measure the performance of a particular business, you got to look at cross entities, which is not really represented. So the charge that comes at a specific legal entity on a standalone basis. So hence, a consolidated view gives, if there's any impact, through impairment. Right? So from that perspective, the standalone impact doesn't really impact or affect the performance of that business in a true shape or form.
Okay, thank you. And second question is, you talked about portfolio pruning as a lever for margin improvement. But to just kind of dwell a little deeper into this, what has driven margin erosion in those businesses in the last, say, 1.5 years? Because, from a business point of view, our utilization is also not to a level where it was, say, a year back. So there seems to be a good amount of avenue in terms of, making good use of the utilization. So just trying to understand from a business point of view, what has driven the margin erosion in those businesses that we're looking to prune?
So various factors, the returns or the pricing is probably not up to the point. There is non-strategic or not core to our region. It doesn't really arrive from a synergy perspective. So various factors. Geo is another area that we feel we don't have the scale to get the benefit there. So it's multiple of those that we try to take actions on. And I think from a current quarter perspective, it's a 20 basis point improvement of margin, while almost a 1% impact on the discontinued business. So as we keep on moving forward, we'll see similar impacts between 20 to 40 basis points on actions that we will take, and we'll keep you posted on specific areas around that.
So what I really meant is in terms of verticals or geographies, can you kind of give a more detailed perspective? Which verticals these are largely in, or which geographies these are largely in?
Yeah, it's across, and I think as we execute or do that, in this current quarter, the impact is more on BFSI, and the geography is ROW. That's where you see the impact coming through, but as we execute the others, we will share that perspective with you as well.
Okay, so of the businesses which you acquired in, say, last year and a half, any perspective you can give in terms of how the margin performance been in those businesses? So the portfolio pruning is largely in the ROW or other businesses, but it's not really in any of those acquisitions.
No, not there. I think that those are, as we mentioned earlier, are integrated to our core offering, helping us continue to, close deal wins to the better range that we see now versus what we saw earlier. So they are fitting in well, integrating. We're working at specific integration. As you remember, we mentioned that this year we are focusing on integrating these businesses, and these are almost 10 different assets that we'd acquired. So integrating their front office, back office, aligning cultural integration with them, and aligning the back-end support, finance, all that takes a significant amount of time. So our focus there is that. From a return perspective, they are performing very close or better to the business case that we got them on. So I think for now, those are moving on track. And I know, Vivek, if you want to add something on the portfolio integration progress that we're making.
Yeah. So I think just adding on to what Rohit said, really success ultimately for us is measured in large deal wins and the influence of these new capabilities we acquired and how well we've integrated them. And then from a operations perspective, the focus is on driving higher value to the customer. Can we take more share of the wallet from the customers with new and expanded offerings? And then from an efficiency perspective, it's about standardization of our systems, processes, and any cost savings there. So those are really the three vectors on which all the integration activities driven across all the acquisitions and the business.
Okay, thank you.
Thank you. The next question is from the line of Dipesh from Emkay Global. Please go ahead.
Yeah, thanks for the opportunity. Just two questions from my side. On BFSI remains soft. So can you provide constant currency quarter-on-quarter growth first about across verticals, particularly on enterprise side? Second thing is why weakness is visible in BFSI. Second question is about low margin business exit strategy, what you highlighted about 100 to 120 million kind of impact annual basis. It is more skewed towards IT business or BPS business? Thanks.
I'll answer the second part of the question, and that probably will have an answer on the first built in. Rohit talked about pruning and rationalization in our portfolio. A lot of what we pruned this quarter is in BFSI, and hence you see softness in BFSI on a quarter-on-quarter basis. But we believe it positions us better and stronger in the longer run. There is no impact or no change from a demand perspective. And on the quantum of pruning, if you look at BFSI on a continuing business basis, excluding the discontinued business, we would have ended up with about 6% quarter-on-quarter growth in BFSI. So on an overall basis, the pruning resulted in a lower reported growth of about a percentage point on a quarter-on-quarter basis.
Mr. Dipesh, you have any other questions?
So just can you give constant currency growth for other vertical also?
I think Barry will have the data and she'll share the data offline.
Thank you.
Thank you. Ladies and gentlemen, due to time constraint, we take that as the last question. I now hand the conference over to Mr. Rohit Anand for closing comments. Over to you, sir.
Yes. Thanks everybody for joining the call today. And just to recap, our Q2 performance has been a result of driving operating actions. We continue to focus on growth as we move into the second half, while watching the macro environment cautiously, especially as that pans out more closely in Europe than anything else. And then, just from a shareholder perspective, reiterating our commitment to, the capital allocation strategy that we've articulated. So in line with that, we've given 20% increase versus last year on the dividend, and we'll continue to focus on shareholder value as moving forward. So thanks to everybody who joined us today.
Thank you. Ladies and gentlemen, on behalf of Tech Mahindra Limited, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.